All right, guys, welcome to my presentation on understanding implied volatility. I'm Nick Galarnik, founder and CEO of Optionfinity. And so thank you for joining today. The usual disclaimer, whatever I discuss here is purely for educational purposes only. Anything else, obviously, just do your own research, manage your own risk, and you should be fine. So implied volatility is probably the most important topic in option trading that a lot of people overlook. And the reason is obviously is that it's quite complex. Now, what is implied volatility, right? Well, it's a forward-looking measure of risk in a certain asset or market, right? What does that mean? That means that if you want to determine how risky or safe an asset is, implied volatility will tell you that by showing you a numeric value that corresponds to the level of risk in an asset, right? Now, the higher the level of implied volatility, typically the higher level of risk. And the reason being is that higher volatility correlates with higher returns and also higher losses. So a stock like Tesla, for example, will have very high volatility because over the past couple of years, it's gone from a couple $100s to many thousands of dollars when you adjust for the splits, right? Now, implied volatility can be used to determine the expected ranges of values based on a 1 standard deviation move 1 year from now. We'll discuss the standard deviations in a sec as well, right? That's very important because it can tell you where a stock may trade to the upside or the downside 1 year from now, right? It's also an important variable that can allow traders or investors to manage their risk and also ascertain optimal decision paths by using stats and probabilities, right? What does that mean? That means that there are a large number of strategies that options allow you to execute on, and it's important to use the correct one. And to decide which strategy to use, you must analyze implied volatility, which will then tell you what the most optimal decision would be, right? Each underlying asset contains its own individual implied volatility. So the question I get a lot of the time is, what's a good implied volatility to monitor, right? And that doesn't really make much sense because each individual underlying asset or index ETF, for example, will have its own implied volatility, right? So it's all relative to its own implied volatility and that asset's historical volatility, which we'll discuss in a second as well. Now, implied volatility will differ for each individual expiration date as well. So that's another important point to note, that every option in the option chain for different expiration dates will have their own individual implied volatility. The reason being is that there may be binary events that occur prior to expiration of certain dates. So for example, let's say that we have an earning event in 2 weeks' time on a certain stock. So 1 week out, the option prices would not reflect there's a binary event occurring because the market would not expect a large move to occur prior to that expiration date. However, the expiration date that contains the binary event would have a much higher implied volatility and thus much, much higher option prices, right? That's where it's important to analyze these small nuances of implied volatility and incorporate them into your trading as well, right? Now, lower implied volatility equates to less risk in a given asset and also smaller expected returns and moves over the course of a year. So you might see a stock like in past times, Intel, for example, was a pretty safe haven stock and it didn't move very much, right? A stock like Procter and Gamble or Walmart, any of these bellwether names that don't have much volatility in their business models, those stocks will have lower implied volatility, right? Obviously, Intel may not be the best example because in recent years, they've fallen by the wayside against AMD, right? But you get my point. And then obviously the opposite is true too, that higher implied volatility equates to higher risk in a given asset. And that also results in larger expected moves and thus returns over the course of the next year. So again, Tesla, as I mentioned prior, is a great example of that. So what is historical volatility, right? Well, in order to determine if implied volatility is high or not, we have to use a measure as a baseline to see if it's high or not, right? And historical volatility acts as a measure of past dispersion of returns on a certain asset or index, right? This is done by tabulating the average deviation from the average price or moving average of an asset or index over the past 1 year time period. So when you use, for example, a 200-day moving average, that smooths out the overall performance of an asset over the past 200 days and gives you a rough average of where it should be trading at on any given day, right? That's why when people use a moving average to determine a crossover, for example, where it can give you a signal to buy or sell an asset, you're determining that based on the price going above or below the moving average, signifying a change in trend, perhaps, right? Now, each individual asset or index has its own historical volatility measure associated with it. And higher HV values will denote higher risk assets, as I mentioned before, someone like Tesla, for example, which can be both bad or good depending on your perspective, right? If you're bullish or if you're bearish. And lower HV values denote lower risk assets, which can also be both bad or good depending on your perspective as well, right? Obviously, lower risk assets are better used for mutual funds, for example, and also for those people that want to have more steady returns over time, right? Whereas the higher risk assets are usually used by those that are younger, perhaps, that have a longer time horizon to invest their money, that want a larger return over the longer time horizon. Underlying assets that trend smoothly in one direction, usually to the upside, they tend to have lower historical volatility values, and the opposite is also true as well. So again, think about like a McDonald's or a Walmart or a Procter and Gamble, perhaps, where they just gradually go up over the past 50 some odd years. Names like McDonald's have done very, very well, right? And they've been going pretty much up and to the right on the chart very, very gradually year after year because they've grown gradually as well, right? Now, one thing about historical volatility is that it does not measure the probability of loss, right? But it can be used to determine how far prices have deviated in the past from the mean or the moving average, as I mentioned prior, right? So stocks that have had a lot of volatility over the past year will have higher levels of historical volatility. And those that have had nominal volatility over the past year will have lower levels of historical volatility as well, right? And so again, as I said before, the importance of historical volatility is that it acts as a baseline with which we measure implied volatility against. And this tells us how cheap or expensive options are at any given moment in time, right? So how does implied volatility work? Well, IV for short, IV is the acronym used for implied volatility, uses a mathematical formula to forecast the probability of a certain movement in a given stock or index. Direction cannot be ascertained in terms of price movement, only the probability of a price movement of a certain magnitude. So this means that we can determine the probability of a stock moving up or down, but we don't know which direction it'll move, right? We can only determine the magnitude of the move, right? So for example, a stock that's $100 with an implied volatility of 20%. This tells us that 1 year from now, the market is expecting this stock to trade as low as $80 or as high as $120 per share, right? And this certainty we have is due to statistics, right? So a 1 standard deviation expected move will give us a 68.2% probable occurrence of this range of values, which means that, for example, 1 year from now on this stock, we can expect that we'll have a price of between 120 and 80 per share with 68.2% probability. Okay. this is important because it allows us to see which strategies make sense to use using implied volatility, right? But elaborating a bit more on the stats side of things. So probabilities associated with multiple standard deviation moves. A 1 standard deviation move on a stock contains approximately 68.2% of outcomes based on current implied volatility. A 2 standard deviation move of a stock contains approximately 95.4% of outcomes based on current implied volatility. And a 3 standard deviation move of a stock contains approximately 99.7% of outcomes based on current implied volatility. Now, what does that mean to those that are not so familiar with statistics? Well, what it means is that if you consider any given stock and observe the number of times it repeatedly increases or decreases in price on a daily time frame, on longer time horizons, it'll become very apparent that almost every stock price movement falls within the 1 standard deviation range of outcomes, or 68.2% of the time, right? This would encompass all of the occurrences where a stock moves in the same direction 2 to 3 days in a row. So for example, when you see a stock going up or down a few days in a row, where it has 2 to 3 green days in a row or 2 to 3 red days in a row, this is what I mean by it occurring within 68.2% of the outcomes, right? A 2 standard deviation move would include occurrences where a stock moves in the same direction 4 to 7 days in a row, which would occur much less frequently. And a 3 standard deviation move would include occurrences of a stock moving in the same direction for 8 days in a row or more, right? And this latter example would occur perhaps once a year, if that. And these may be considered black swan events, right? So they're very infrequent events. It might be, for example, a short squeeze on a certain name like GameStop or Bed Bath & Beyond, where a stock goes up incessantly for 8 days or more in a row, right? It's not a very common occurrence, right? The most common occurrence will be, 1 to 3 days to the upside, or 1 to 3 days to the downside, right? You usually don't get, 4 to 7 or 8+ days in a row where a stock declines every single day or rises every single day, right? So important to understand this as well. Why does implied volatility matter? Well, it matters because it's the primary deciding factor in the pricing of options, right? If you analyze the various Greeks attached to an option, right, you have delta, gamma, vega, theta, and rho. Rho, the last one not being so important, right? But you have delta, gamma, vega, and theta, right? Vega is a variable that's attached to implied volatility. So when you see that number, that tells you how much the price of a given option will rise or fall for every 1% increase or decrease in implied volatility. So for example, let's say we have an implied volatility of 25%, and a certain option has a vega of $1, right? This means that every increase of 1% on the implied volatility will result in a $1 increase in that option price, all else remaining equal. Conversely, if the IV were to fall by 1%, that option price would fall by $1 as well, right? So you can see how you get, a lot of importance from analyzing implied volatility, because many people that I know buy options blindly, and what they do is they buy typically when IV is very, very high prior to a binary event such as earnings, right? And doing that is extremely risky because you can be correct in ascertaining the direction without actually winning, because the implied volatility comes down so much post-binary event, right? So let's say, for example, you buy an option, a call option. I remember a while ago, I was trading Meta or Facebook prior, and I bought some call options that were deep in the money. The stock price rose a little bit after earnings, and I profited a little bit as well. But the following day in the morning, the entire option chain for that week, both calls and puts, unless you were deep in the money on the call side, every single option was red. And the reason being is that the stock did not experience the expected move that the market was pricing in on the earning event. And so everyone that bought an option essentially lost money, regardless of if you were correct or not. You may have bought call options that expired that same week or a week further and still ended up losing on that trade. So IV is also very important because it acts as a measure of perceived volatility, which can provide a trader or investor with a purview into what kind of asset you're looking at. So if someone tells me, they say, Nick, look at a certain stock for me, right? And I open the option train right away, and I see that it has a very high implied volatility. I know that this is probably a riskier asset. If I pull up the chart, I'm likely to see a very, very wide range of values over the course of the past year, right? Additionally, implied volatility, understanding it, allows the trader or investor to determine the optimal strategy to use in each situation, right? There are many different strategies to use, right? If IV is very high relative to the historical volatility, you want to be selling options perhaps, or not buying them. And conversely, if IV is very low, you want to look at perhaps buying options and not selling the options, right? Because it's all about probability in this sense. So as I just said, right, when IV exceeds the historical volatility, selling strategies should be considered while buying strategies should be avoided. When the IV is below the HV, buying strategies should be considered while selling strategies should be avoided. Now, there are a few tools you can use that are readily available on most brokerage platforms, and they're known as IV rank or implied volatility rank and IV percentile. So the at the money, for IV rank, what is that? Well, the at the money average implied volatility relative to the highest and lowest values over the past year, right? So for example, we're actually going to do an example in a second, but when IV rank is 100%, this means that IV is at its highest level of the past year, meaning that option prices have never been more expensive than they are right now. Conversely, when IV rank is at 0%, this means that IV is at its lowest level of the past year, and options should probably be bought hand over fist, unless, of course, IV rank is 0% because of an event such as Microsoft acquiring Activision, wherein Activision stays in a very, very tight range of prices for a long time before the deal is consummated, right? That could be one anomalous event, for example. When IV rank is 50%, this means that IV is right in between the highest and lowest levels of the past year. So short options become much more lucrative when IV rank is above 50%. And obviously, the higher it is, the more lucrative those strategies will be, right? So, you have iron condors, iron butterflies, cash secured puts, covered call strategies, bear call spreads, bull put spreads, right? Short straddles, short strangles. It depends on what your overall thesis is, but there are a variety of strategies to benefit on shorting options, right? Shorting meaning selling the option short, right? So selling to open the position, not selling it as if you already own it, right? And then conversely, when IV rank is below 50%, longing or buying options becomes much more lucrative, right? Because you have a higher probability of winning because you're paying a lower price at the onset of your trade. So a nice thing about buying when IV is very low, especially when you buy on longer term time horizons, is that you can win in a number of different ways, right? You can win on IV percolating into a binary event, for example. You can win on a directional move in your favor. If you buy a call option, the stock price goes up, you win. You can win on both of those as well. So for example, let's say you buy a call option or a put option. In the case of a call option, you buy a call option and the stock price goes up and the implied volatility also goes up as well. In that case, you're going to win double because not only is the delta benefiting you, but the vega is also increasing as well, right? There's, however, a key drawback of IV rank, and that is that it does not smooth out one-time volatility-inducing events, which can result in very misleading readings. So for example, in the last year or so, Twitter was rumored to be acquired by Elon Musk, right? And when that happened, the IV skyrocketed on Twitter, right? So that could have been an anomalous event that caused IV to spike temporarily, right? And this, I'll show you why this is important. So here's an example right here. I'm gonna go back to Twitter in a sec, right? So an example of IV rank. You have a stock with a high IV of the year of 100% and a low IV of the year of 20%. Now the volatility range for the year is 100 minus 20, which is 80%, right? A high IV rank would be anything above the halfway point of this range. Now half of 80% is 40%. So if we add this to the low of the year of 20%, we get 60% as a midpoint between the high of the year and the low of the year. Therefore, an IV of 60% on this given example stock equates to an IV rank of 50, which tells us that option prices are reasonably priced because the current IV is exactly between the high of the year and the low of the year, right? However, let's say, for example, that in the case of Twitter, you have an IV rank of 100, wherein the option prices are the priciest they've been over the past year period. And this could be, again, due to a binary event or some anomalous event like a takeover attempt, for example, right? Now, when you're buying, when the IV rank is at or near 100, your risk is much, much higher because you're paying a massive, massive premium over the long run average price of the option, right? And conversely, when the IV rank is much, much lower, let's say it's at around an IV rank of 10, for example, right? That's where option prices have never been cheaper, right? And there may be a reason why they're very, very cheap. Again, research may be required if that's the case, right? But the whole point is that this tool can be used to help you to find trades, and it's available in most scanners where you can sort by IV rank over the past 3 months, 6 months, and 1 year period. And you can also sort by market cap, for example, in different industry if you want, and you can find some very interesting trades. Now, caveat is that you want to look at high liquidity options only whenever you're trading options. So I must say that as well, is that you want to look at the average daily volume, typically on the stock itself, which will correlate to the average volume on the option itself as well, which will correlate to a higher open interest across options across the entire option chain, right? So you never want to be trading options in an illiquid asset, because that means that you might be able to get into the asset perhaps, right? Or into the trade rather, but it'll be very difficult to get out of the trade, right? And a lot of slippage can be occurred wherein the bid and ask spread is very, very wide, and that can result in losses that are unnecessary overall, right? So a lot of people that hear about a certain new name being talked about perhaps on Wall Street Bets or on Reddit, and they go and they just dive right in without even looking at the implied volatility or the liquidity at all. And then all of a sudden they see that, hey, I bought some call options and I want to sell them because the asset is running, but I can't do so, right? So very, very important to analyze the liquidity of any asset, right? So the tighter the bid-ask spread is, the more liquid the asset typically will be as well, right? Now, I mentioned another methodology of analyzing implied volatility versus historical volatility, and that's IV percentile, right? This one, again, I provided a formula here as well, not really necessary to understand, but just an example. And again, your platform or your brokerage will have IV percentile or IVP in its scanner as well. So you can scan by IVP and find the top IVP stocks, right? Or the lowest IVP stocks, for example, in the case of buying options, perhaps. And this can be a great way to find trades that may not otherwise be apparent, right? So what is implied volatility percentile? Well, it's a number of days in the past year wherein the HV was lower than the current implied volatility divided by the total number of days, right? And this depicts the percentage of days that IV is traded below the current level for the past year. So for instance, if IV percentile is 20%, this means that IV is traded below current levels only 20% of the time in the past year. So for example, let's say Suncor, which is a Canadian oil company, they have a low IV of the year of 20 and a high IV of the year of 45, right? The current IV is 30, right? Given all this information, you plug it into the formula below, and you get 67%, right? This means that IV has not been higher. This means that IV is higher than it has been 67% of the time over the past year, right? So that's important to note, because it tells you that IV is pretty high right now, and perhaps you want to avoid buying it, or maybe you want to sell some options using that information, right? So how to use IV rank, and IV percentile, right? So the first thing is you want to determine if IV is high or low using IVR or IVP, right? Then it's very, very important to do research on why option yields are very, very cheap or expensive on certain names, right? If IV is very high, like I've had a lot of questions about, or surrounding certain names where someone sees, an opportunity to sell some cash secured puts or covered calls, for example, or an iron condor that yields a high return on the strategy, right, with decent probability, but they don't delve into why the IV is so high. And oftentimes they might miss, a key event like earnings, for example, or an FDA decision, or some kind of competitor earnings, for example, right? Like that's a key thing to look at as well, right? Is looking for competitor events as well, because so as an example, right now, as we speak, NVIDIA had some bad news after hours today in the market. And as a result, AMD is down with it. So NVIDIA is down 6.5%, or about $10 per share, and AMD is dragged down 4%, right? So typically when you see a competitor of a company you're watching report earnings or have a certain event, that can cause the company that you're watching to fall or rise in step. And that actually provides an opportunity for you. If you notice that the implied volatility on that name is very, very low, then you can benefit off of that by, for example, buying Meta when Snapchat reports earnings, or vice versa, or buying, Coca-Cola when Pepsi reports earnings, or vice versa, right? That kind of information can be very, very useful in identifying opportunities that are very unique and not very apparent to anyone else in the market, right? So IV rank, and IVP can be used to help identify option selling opportunities by finding underlying assets that have high IV, and also by finding underlying assets that have low IV in the case of buying opportunities, right? And it's important, again, I can't stress this enough, to always define and manage your risk on every single position you take with options, right? The majority of market players fail at longevity because they don't manage their risk, right? So I know a lot of people, follow Wall Street Bets and different forums on Reddit. It's a very common thing to follow right now. And there's a tendency to post loss porn, right? Which is kind of like a way of making fun of yourself when you've lost a lot of money, right? But again, oftentimes it's just unnecessary, because people are taking massive risks without understanding what they're actually doing, and they're burning a lot of money in that way, right? And the last thing is do not trade assets or strategies that you don't understand intimately, right? If you don't understand a strategy but you hear from someone else, don't just copy them blindly, because again, a lot of nuances are required to navigate using certain strategies, right? Like as an example, I mentioned this week about Meta, a straddle in chat, the 160 straddle. It was about $6.50 roughly when I mentioned it. And oftentimes, so the strategy, for those of you that are unfamiliar, it entails buying a call and a put at the same strike price for the same expiration date. So for this coming Friday, the 160 call and the 160 put combined traded for a total cost of $6.50, which meant that you either needed the stock price to fall or rise by $6.50 to make a profit on the trade. Now, yesterday, Meta traded down to as low as $54 per share. So the put side was around $7 per share at the high of the day. Today, Meta traded as high as $167.50 per share, and the call side traded as high as almost $8 today. So in this kind of strategy, what you may have done was sell the put option for the total cost of your overall trade, hang on to the call option, wait for a recovery. If it doesn't happen, you sell it by Friday, take whatever you can get. If it doesn't recover as Meta did, and it pops to 167.50, for example, you may win on both the call and the put in different legs. So again, nuance is very, very important. Now, looking at an option chain, I'm going to get out of this presentation. I think so. I finished over here. Let me see. There we go. Any questions? We'll go over questions in a second, but I'm going to pull up an option chain just to show you guys what I mean by IV, right? So I mentioned some different terms earlier, right? So here's NVIDIA. You can see right here, you have the IV last, right? So this is the implied volatility right now. This is the historical volatility close percentage, right? So this tells you what the volatility over the past year has been roughly, as well as the current forward-looking volatility, right? And this is a change from yesterday right here, right? So it's down from yesterday. I mentioned earlier about liquidity as well, right? So option volume is very, very high over here, right? And you can see that across the option chain, typically you're going to see a lot of open interest over here, right, in this column, as well as a lot of volume, right? And so this correlates to very, very tight bid-ask spreads of, for example, 3 cents wide over here, 3 over here, 3 over here, 2 over here. Very, very tight bid-ask spreads. But if you're trading a name like, for example, Ambarella, which is also in the same sector, it's a semiconductor stock as well, right? You'll notice that their liquidity is not as solid. So option volume today for the entire day, 11.6 thousand, right? The open interest, negligible, and the volume also negligible as well. And consequently, spreads are a bit wider here. Maybe not the best example, but if you pull up, a random biotech stock like Intercept, for example, you're going to see, again, 2,000 contracts traded over the course of the day. And again, the spreads here can be quite large, like, 490 to 540, for example, 55 cents to $1. This slippage is not good at all when you're trading in and out, especially intraday, right? It results in a lot more loss than you need to take on the entering and exiting of a position, right? So I also mentioned that IV is different for each expiration date. So back to NVIDIA, for example, right? So you can see that for each expiration date, right over here in the right-hand corner, the IV for this coming Friday is 58.4%, right? If you go to next Friday, you're going to see 52.1%. Next Friday, 53.4%, right? And so on and so forth, right? As we go out further and further, you're going to notice that IV will decline or rise. Typically, it'll go down over time because the premiums you're paying for further expiration dates are baking in the assumption that you're going to see large volatility on that name, right? So quite important as well. There's a lot more to discuss around implied volatility, but I don't want to delve too deeply into other topics like skew, for example, because that's a deep rabbit hole as well. So I'm going to end it over here. I appreciate all your time. And if you guys want to do some Q&A, I'm going to stop the recording and feel free to fire away.